The 13Fs are released. The 13F filings are mandatory reports that large fund managers in the United States have to submit to the SEC, that's the Securities and Exchange Commission, every single quarter. Now, what do these reports actually show? They list out all the stocks these managers are holding at the end of the quarter, including the company's name, the ticker symbol, the number of shares held, and the total market value of each position. In other words, they work like an X-ray of Wall Street's biggest players. Why are they important? For retail investors like us, 13Fs are almost like a cheat code for the market. They give us a peek into where the world's most successful investors in giant funds are putting their money. They reveal market trends, since firms like Berkshire Hathaway, Warren Buffett, Bridgewater, Ray Dalio, or Pershing Square, Bill Ackman, move billions of dollars. They help us spot strategic shifts, like trimming expensive stocks or betting heavily on promising sectors. But of course, there are limitations. A 13F only shows you the portfolio snapshot at the end of the quarter, not in real time. By the time we get to see it, those decisions may have been made weeks, sometimes months earlier. They don't show everything. For example, no derivatives, no short positions, and no international holdings. They only cover U.S.-listed equities. The big moves in this round of 13Fs. As I said at the start, these quarterly filings are like a window into the minds of the world's best investors. It's almost like getting to spy on the sharks of Wall Street. You can literally see what they are buying, what they are selling, and how they are adjusting their portfolios. And in this latest round, we've seen some fascinating moves from four heavy hitters: Warren Buffett, Li Lu, Bill Ackman, and Seth Klarman. So, let's break it all down. Buffett's Apple decision. Let's start with the Oracle of Omaha himself, Warren Buffett. In Q1 2024, Buffett began selling down his Apple stake. Over the course of 3 quarters, he sold more than 605 million shares, slashing Apple's weight in Berkshire's portfolio from 50% down to 25%. That left him with around 300 million shares, and for a while, it looked like he was done selling. But the most recent 13F shows another sale of 20 million shares, about 6.67% of his remaining position. Why would Buffett sell Apple? Buffett himself has mentioned a few possible reasons in the past. 1. Concerns about corporate tax rates rising. Better to realize profits now than later. 2. A desire to build up more cash reserves, given all the uncertainty in the world. 3. Apple's valuation ballooning. Trading at APOE ratio of around 38, expensive for a mature company. But there might also be another factor: tariffs. In Apple's Q2 earnings call, Tim Cook warned that tariffs could cost Apple about $900 million per quarter. It's possible Buffett looked at that situation, thought it could get messy, and decided to trim a little further. Other Berkshire moves this quarter. Bought United Health, a fresh $1.5 billion position. Increased Chevron by 3%. Reduced Bank of America by 4%. DaVita Healthcare by 4%. So, the takeaway? Buffett hasn't lost faith in Apple. It's still Berkshire's largest holding, but is taking profits, lowering risk, and diversifying. Li Lu's big bet on Pinduoduo. Next up, Charlie Munger's protege, Li Lu, made headlines with a huge new purchase. Himalaya Capital bought 4.6 million shares of Pinduoduo, worth about $482 million. That instantly made it the fund's second largest holding, accounting for 18% of the portfolio. What exactly is Pinduoduo? It's a Chinese e-commerce giant, competing with the likes of JD.com and Alibaba. Their key innovation is the group buying model. Shoppers get big discounts if they invite friends or family to purchase together. Rather than taking a cut of each sale like Amazon, Pinduoduo makes most of its money from advertising, as merchants pay to promote products on the platform. And of course, in 2022, they launched Temu, the global platform offering factory direct bargains to the world. Why does Li Lu like it? It's a low-cost business model that builds a powerful competitive advantage. It also creates a network effect. The more people join, the cheaper the experience becomes. Even though operating profit dropped 38% year-on-year, the stock trades on APOE of just 12.75. Li Lu seems willing to accept short-term profitability pressures, betting instead on the company's long-term growth trajectory. Bill Ackman's entry into Amazon. Over at Pershing Square, Bill Ackman made a splash by initiating a massive new stake in Amazon. The fund invested around $1.3 billion, making it Pershing's fourth largest holding, representing 9.3% of the portfolio. Ackman got in after the stock had fallen roughly 30% earlier this year. Since then, it's bounced back by about 40%, a big win already. Why Amazon? Ackman described it as a fantastic franchise that he was able to buy at an extremely attractive price. He wasn't spooked by short-term fears around generative AI or U.S. tariffs. Instead, he focused on Amazon's fundamentals and its ability to keep delivering 20% plus earnings growth per share. And just to make things even sweeter, Amazon CEO Andy Jassy recently said that tariffs haven't had any meaningful impact on the business so far, another reassuring sign for shareholders. Seth Klarman doubles down on Google. Finally, we've got Seth Klarman of Bullpost Group, who doubled down on Google. The fund increased its stake by 27%, making Google now 11.3% of the portfolio, with about $467 million. Interestingly, this is in contrast to investors like Li Lu, who've been selling Google recently. Two competing narratives. One, the bull case. Google dominates internet search and prints cash through advertising. Services like YouTube, subscriptions, and Google Cloud are all highly profitable. They've got $95 billion in cash, nearly $63 billion in annual profit, and trade at APOE of just 22. 2. The bear case. Tools like ChatGPT could slowly chip away at Google's dominance in search. User behavior may shift, and that could impact ad revenues long term. But Klarman clearly sees Google as undervalued, highly profitable, and financially rock solid, and is leaning in. Wrapping up, so what can we take away from this round of 13FS? Buffett is trimming Apple, but not abandoning it, a classic case of de-risking and taking profits. Li Lu is betting big on Chinese e-commerce through Pinduoduo. Bill Ackman saw opportunity in Amazon's dip and has already been rewarded. Seth Klarman is doubling down on Google, confident in its dominance despite new challenges. And remember, these filings aren't buy or sell recommendations. They are best used as an ideas list, a way to see what the world's best are doing and then do your own research. If you enjoyed this breakdown, make sure you subscribe, hit the like button, and ring the notification bell so you don't miss the next update. Thanks for watching, and I'll see you in the next one.